Well, thank you so much for joining me on the podcast, Tarun. Super excited to have you here. Big fan of what you have done. And so really honored to get the chance to speak with you.
Hey, happy to be here. Excited to chat.
Thank you. I would love, so I start each podcast with a little bit about everybody's background, kind of their unique story and falling down the rabbit hole. I feel like it's kind of endless once you peer in the hole. And so I would love to hear a little bit more about like your journey and just getting into crypto more broadly.
Yeah, for sure. So, I think in 2010 and 11, I worked at a company that was building ASICs, so application-specific integrated circuits. That's like hardware, custom hardware. Not at all for crypto, not at all for mining. It was actually for doing like simulations of proteins. But at that time, we put out this chip order for $25 million, and the supplier ghosted us. And there were not a lot of people buying chips at that time, so it was like very, very weird. And it became this question of like, who is this person? Who are these people who are like buying up custom chip space? It's very different right now. I'm sure many of your listeners heard of the like semiconductor shortage and all this type of stuff. And part of that has to do with the fact that demand for semiconductors has gone up because of like LiDAR, self-driving car chips, whatever. There's like there's way more custom silicon than there was back then, even though it's only 10 years ago or so. But so we were just like, what is this? And then we found out eventually our supplier came back and was like, we'll give you a 10% discount. And we were like, fuck you. You have to tell us why you disappeared for 6 months. And that sort of is what led me to learn about Bitcoin. And then I, mined a bunch, sold it all at the bottom in 2013. And so don't take my mining investment advice. But then kind of I had kept in kind of touch with the academic literature on crypto. Partially because I worked in this company that did a lot of distributed systems work, and very few people that I worked with really believed that Bitcoin actually worked. And then once it was sort of like clear in practice, it was very hard to take down. It took a while before sort of the math was able to be made to like really describe like under what conditions does it work, how well does it work, how big can the network get, like all these kinds of properties, which are very non-trivial in a lot of ways. And that sort of was when I started reading a lot of these papers and trying to convince my coworkers, and a lot of them were like, this still doesn't seem like it makes sense, like just seems like a bad database. And then after that, I went into high-frequency trading, still working on some hardware simulation type of stuff. And I was reading a lot of proof-of-stake papers, like the Algorand paper in 2016. And the one question I'd always had was, how do people actually measure risk in these systems in a way that's, meaningful when the market price of these assets are changing, right? Like a proof of stake system is only really as secure to some extent as how much the total assets staked are worth, right? And so one question you might have is then like, well, what happens if someone could manipulate that price or like make some type of derivative asset that like causes the amount staked to go down? And I think at that time in proof of stake land, we were in a much more optimistic world, where it was like, just like the cryptography will work and you won't have to worry about the financial aspect. But that's kind of led me down this rabbit hole of writing simulations to stress test these networks the way you stress test trading strategies, and would find sometimes some weird things. And I showed them to people who were building different layer ones at that time. And, I think a lot of them were like, hey, do you want to work for us? And I was like, not really. I found people who raised money for layer ones in 2017 sketchy in a particular way. Maybe I was the idiot, but I just really was like hard to not find them just like a little bit off-putting in some way. And so that just kind of led me to be like, hey, no, I'll like maybe consult or something. And that sort of consulting thing kind of led to me starting Gauntlet. So that's sort of the long form version of this.
Beautiful. Super interesting. It's funny how long it takes people to kind of wrap their heads around the blockchain industry. I mean, even you were saying kind of proving that like in a math sense. Is that how, like, I would say more holistically you try to ideate? I guess even with Gauntlet is like from like the point of view of like math. Is that like how you kind of approach different topics? Can I prove this in a mathematical sense?
Yeah. So, I mean, for me, it was more like, there has been a lot of work on distributed systems since the 80s, sort of a lot of mathematical theory, a lot of reason for why these things work. And one thing I always found kind of weird about the cryptocurrency space at that time was people would be very rigorous about the math and the crypto side, like how the signature scheme works. But then the distributed system side, like, I guess everyone inherited this thing from Satoshi where it's like fine to be wrong with like a bunch of basic math assumptions and like probability assumptions that are made. And there kind of was like extreme informality about that stuff. And it was very weird. It's like, if you read one of those like Bitcoin for Dummies books, they'll spend 2 chapters teaching you what an elliptic curve is and like how ECDSA works. But they'll spend 0 time telling you like, what's the probability of, how do you compute like the probability of the block doesn't get finalized? They'll just be like, oh yeah, it's 6 blocks. Why 6? I don't know. I'm just going to tell you it's 6, right? Like and that aspect of it, I always found misleading because it's like it is sort of untrue, and so it's very hard to believe some of those claims. I think that engineers working on things knew like the realities of like when it doesn't work. And they had really good intuition, but they had no way of formalizing it. And, for me, coming from more of a mathematical background prior to working in hardware, to me, it was like a little bit, there's a bit of smoke and mirrors. But then once people actually figured out how to formalize it, it started to make me realize that there's something very deep here that existing decentralized systems and distributed systems did not really have, and kind of figuring out how to harness that in some new way would be really interesting. And so that's it. That's sort of my background into it was more that, and I think it's like, to be into crypto in 2011, 2012 was either you were like, I'm just going to make a quick buck, or you were like a true believer in the philosophy and had no clue how the system worked or why the code worked. Or like, if you think about Bitcoin itself, it had a bunch of CVEs, it had a bunch of like bad hard forks at that time. All this stuff that, if you saw on the network now, people would be like, oh, it's like a fake blockchain, right? So I think there's also this fact that like, yes, people who are maybe more risk averse like me, like needed to see some sort of proof of that form. People who are engineers maybe only needed to see that it ran in practice. But I do think that sometimes there's a bit of sleight of hand there because, well, maybe it's running in practice, but it's only really running on like 8 nodes, and you didn't
True.
check.
True. No, it's very interesting. And I would add one more third group, people that were buying Bitcoin for Silk Road. So
for sure. Of
definitely
course.
a big group, but no,
for sure. That's fair. That's fair. I didn't mean to trivialize, the Swiss and the Switzerland economy.
Yeah. No, super interesting though. No, I always find it very unique in how kind of people approach the space, because there's multiple different avenues and people can kind of come at it from different angles and then ultimately see the promise and then never leave. So it's fascinating to me. So now, like, you're very busy in your day to day. You're leading Gauntlet, and also one of you and Robert on the venture sides with Robot Ventures. Could you maybe just give a brief, like, high level overview of what Gauntlet is for those that are uneducated, and what, like, purpose are you trying to serve into the market on, like, creating, like, the models and, like, the incentive management behind Gauntlet? And then definitely want to talk about Robot Ventures as well.
Yeah. So I think one thing that I'd realized as I started really running simulations of proof of stake networks and starting to, like, analyze them more as trading strategies and less as, like, cryptographic insurance funds, because in some sense they are a form of a trading strategy. I realized, like, it's basically impossible to have completely static parameters. Like, I set the inflation rate once forever and it works, or I set the fees once forever and it works. In the sense that, like, if you had these demand shocks, you would suddenly have to change your gas prices. Or if you had these price shocks, you would suddenly need to change your inflation schedule. And there's sort of no way around that. And so one thing, I realized was, like, hey, when we're running these simulations, part of the reason, the thing that people were interested in 2018, 2019 was, like, hey, they wanted, like, a value for their parameter, right? They wanted the inflation rate, what the issuance rate should be, or they wanted, like, a gas fee, or they wanted to show that, like, some particular mechanism that would like provide some lower volatility. But as we were doing all of this research, and you can think of it as, like, we were doing audits effectively, like, we were running these simulations against the real code. And the difference between, say, like, a normal security audit and sort of these things that are more on the economic side is the normal security audit looks for things where, under some conditions, your code says 1 + 1 = 3. 1 + 1 = 3 is very bad, because that means I can put 2 coins in and get 3 coins out, right? And I can keep doing that until I drain a contract. There's many other forms of these, but I think that's, like, always the highest, simplest example of how to explain that. The economic things are much more behavioral based. So, for instance, like in the Uniswap contract, a form which is formally verified, the formal verification will say something like, hey, if you put in a non-zero amount of trade, like I put in 5 ETH, then I have to get out a non-zero amount of USDC. I can't just put money in and then the contract says, nope, not giving you any money out, right? On the other hand, that doesn't tell you anything about, any guarantees about how much you're getting. So, like, for instance, in sort of like classical minor extractable value terms, if a user sends in a trade for 5 ETH and a bunch of people who are liquidity providers see it and then send transactions ahead of it to remove their liquidity, well, I may have thought I was getting, $5,000, but afterwards it turns out I'm getting much less. And so there's sort of this aspect of like expected behavior, which is different than, like, absolute worst case behavior, right? There's, like, sort of security audits are looking at absolute worst case behavior. Economic stuff is looking at everything in between worst case and average. And you kind of have to look through all of those. And so we were doing this initially more as sort of like an auditing type of thing. And then we started working with DeFi protocols. Sort of first customer of that form was Compound. And that was when we realized, actually, there's this huge universe of parameters that need to be continuously optimized. And I think if there's anything I've learned in the last 5 years of being in this industry full time, is that security has gone from being like, hey, here's a one-shot thing, like, hey, like, we analyze it safe, to, like, it's always continuous. Like, whether it's, you look at something like the Nomad bridge hack, which was a deployment issue. Like, actually the smart contracts barely changed. You could say they didn't change, but the way they deployed it to the chain initialized things incorrectly and caused something to go wrong. There's sort of this notion that security in blockchains is necessarily much more continuous and requires a lot more monitoring than security elsewhere. And I think in some ways the economic side is more obvious that that's true, because hey, the market has a regime change and you need to suddenly be more conservative with the amount of leverage your protocol is providing. Makes a lot of sense, right? Like, it doesn't make sense to say, hey, here's a bank that's going to offer an interest rate to borrow at an interest rate that they'll give you, and they're never going to change it. It's going to be that forever, right? That's just like not realistic in a lot of ways. But even the auditing side has the same problem, in the sense that like deployments change, like other contracts interacting with you like change, and that changes kind of some of the assumptions that are being made. So, long story short, we started to realize, hey, people actually need this monitoring of their economic parameters, like their margin requirements, their fees, their interest rates. And you need to optimize those to trade off two things: how much risk your protocol is holding, like a DeFi protocol or a lending protocol, and how much revenue it's generating. Because the revenue acts as your insurance fund to some extent if there's sort of an attack, and the risk is obviously like, well, if everyone's borrowing and then defaulting, then like the protocol's not safe for lenders who are pulling their capital in there. The latter is actually quite important for risk too, but in an indirect way. So, the simplest example of this that I'll give is like the Mango Markets attack, which took place in November or October, sorry. And in the Mango Markets attack, there's sort of this implied weird sort of property of the protocol that I think they hadn't been optimizing parameters. They kind of kept the same parameters since when they launched, but when they launched, it was this huge bull market. And so they were like, hey, you can borrow how much ever you want against Mango. Now, the problem is the Mango protocol was not diversifying its treasury sufficiently quickly. So it was mainly denominated in Mango. And so what that means is that if we look at the treasury as sort of an insurance fund, the treasury is denominated in Mango. So if someone puts Mango as collateral and borrows stablecoins, the protocol is actually extra long Mango, like in a sort of super linear way. Like the protocol is owning the Mango collateral of the borrower. They're also owning Mango collateral in the insurance fund that's supposed to be allocated to that borrower. And so if someone manipulates the price of Mango, they're actually manipulating it more than 1x for that user, because they're manipulating the share of the insurance fund. Now, if the insurance fund had more USDC, then the manipulation of Mango wouldn't impact the net position of the protocol. And so then that extra convexity was sort of, you can take advantage of that, and then the insurance fund can't cover anything at some point. So the reason I bring this up is there's sort of a sense in which these protocols need to actually be watching these things, because like in times of high growth, it might make sense to actually be collecting a lot of revenue. But then when the market shifts, you actually really do need to change how you're doing this. And so that's sort of the function capabilities we serve, mainly for lending protocols right now, but also perpetual protocols. And we're also building this protocol for doing this insurance fund type of thing called ERA. So at a very high level, that's sort of what we do is amazing. There's a lot of stuff there, so I apologies.
No, it was good. Fascinating just listening to it all. It's amazing how complex I guess things can be that are not extremely obvious on the surface. And so building software and models to highlight those is definitely welcome in the space, and something, that has been happening, I guess, in TradFi for a long time, but kind of porting now those, porting those functionality over into the crypto ecosystem. Are you also, so I know like DeFi is the main focus today. Are you also going to be focused on like gaming or any other like branches in the future?
Yeah, so we also do sort of like incentive optimization, which is sort of like, how much should you pay in token rewards for different types of users? And we work right now. One of our customers is Immutable, which is this layer 2 for gaming, for optimizing how their incentives work. So at a very high level, you could view what we do as like, we take on-chain data, we take your code, we make simulations, and we'll give you some notion of like optimized parameters as given new data comes in.
Yeah.
Right? We take in the data, run these simulations, and give you kind of parameters. So anything that fits that mold where there's economic value to those parameters and you really, really care about being careful with them, that's what we'll do. So whether that is gaming directly, whether that's indirectly through kind of the NFT exchanges parameters, we'll definitely do it. I think the hard part is gaming right now is like it's like a little too far from
mainstream.
I guess, like, yeah. But like it doesn't seem like it's kind of like stuck per se. But I don't know. What's your opinion? Where do you see blockchain gaming? Because like I personally, I don't play video games, so it's very hard for me.
I don't play video games either. So I wouldn't be the best person to ask on that question. I'm more, I like the infrastructure stuff. And so to me, this is extremely fascinating on just, the different vulnerabilities and just being able to highlight those. But yeah, gaming to me, I am fascinated just on the onboarding sense. I mean, even with Electric Capital's report that like 80+% of people, their first time on-chain interaction was through an NFT. And even looking at like popular Dune Analytics dashboards showing how few people actually interact with like smart contracts. To me, the reason why I'm fascinated on, or at least like interested on the gaming side, is just one unique game could bring in the entire user base of Web3. But to your point, it is still very early in the gaming front, and building a good game does take a lot of time. I think possibly to start will be a relatively kind of simplistic game. Probably not like a AAA game, but something that is more like among friends, or just like pretty easy, but just kind of catchy. But we'll see.
Yeah, I mean, I think the concept of a AAA game has always been something I find kind of weird, because in some sense, if we look at like gaming things that were good investments in the past, a lot of them are things that don't look like they were going to be AAA games, but they like accidentally did. Or like they were like mobile games, which like every game developer shits on, right? Like, so there's kind of this like weird thing where I suspect it's just not going to look like the modality that people have for like this notion of like League of Legends or AAA or whatever.
True. I agree.
Which I think somehow like crypto investors have not really leaned into. They seem to be wanting to invest in these games that are like team from, Riot Games, whatever. But like, I kind of feel like it's going to be, it's more likely to be like the Dark Forest type of thing to me. That's my guess. And I don't play games, so I'm a bad assessor of this. Then it is like let's try to make League of Legends. Let's shove a token into League of Legends somehow. Yeah,
well, there's definitely a lot of following kind of in the venture space and just following narratives. So it wouldn't surprise me that that's also happening in gaming. But on that front, you and Robert, obviously running Robot Ventures, I would love to like hear a little bit more about how you kind of manage your time between Gauntlet and Robot Ventures. But what are the things that you really look for on the venture side and things that excite you?
Yeah, so I mean, I would say that like 95% of my time is on Gauntlet, so it's like mainly not Robot Ventures. But the nice thing is there's a lot of synergy.
Yeah.
In the sense that I'm talking to people when they're kind of like, early starting out and trying to walk through what they're working on. And a lot of that actually is the same as like talking through things with people who we work with, who are our customers. And so I was already kind of doing this. In fact, the person who sort of tried to convince me to start investing, I think in 2020 or 2019, late 2019, was like, hey, have you heard of this protocol? Like, what do you think? And I was like, you're the 15th VC to ask me today. And then they were like, oh, how could you be the first to ask you today? I was like, well, I should be the investor then, right?
Yeah.
And so that's sort of how it started. And so a lot of it comes down to like, hey, I'm already like kind of reading all these papers. I'm writing a lot of research. People are making protocols based off research that we do at Gauntlet. And so it kind of was a nice synergy in a lot of ways. And so it just kind of started from that, and then, kind of bloomed into, us doing a lot of investments in different parts of the world. But yeah, like, I would say my approach to it is I view everything from the purely technical or financial lens. I have no ability to assess NFTs or games. So
nice. I mean, I try to approach, my background is product/technical. And so I try to approach it from the technical side as well. And I'm curious, just looking at some of the portfolio companies that you have on the website, you're kind of, obviously very big in the Ethereum ecosystem, but also have some different infrastructure or different investments in the Solana ecosystem and different kind of bridges. Is there a community or ecosystem that you're like particularly excited about? Or are you generally kind of agnostic to the technical underpinnings that teams decide to build upon?
I think that the philosophy, I guess, that we have is, it's probably too early in this industry to be hyper worried about like everything always being competitive, in the sense that probably everyone needs to grow at this point for the industry to make it, as opposed to like one winner take all type of thing. I don't really, I've never I refused to use Twitter until basically the pandemic. I like barely touched it. And part of the reason was like, I just couldn't stand like reading crypto Twitter, like people just like, especially in the bear market, like last time was just like very annoying, where everyone was like a cheerleader for something. And it just like, I was not that. And my view is like, hey, look, whatever solutions work from a pure technical standpoint or from a pure engineering standpoint, or even a pure product standpoint. Although, I think the latter thing, if it doesn't have the former in crypto, tends to get exploited. But is that it doesn't totally matter exactly what you're starting with, provided there's like a baseline level of engineering or technical prowess. I think, there have definitely been a lot of projects that I would say kind of faked it till they made it, and eventually inherited security properties that made them much more stable. I think Solana is a great example of this. I remember the week they launched, there's this bug in their consensus protocol that another layer 1 helped them figure out and fix, which was near protocol. And I thought that was like kind of interesting. Like I was like, would that have happened a year later? Probably not. If that. So it's like, but the idea of the spirit of like, hey, like people didn't really like, we're not like quite as competitive and we're helping each other, was certainly much more prevalent in 2019. And I just generally think like, I'm not sure the precise choice you make makes all the difference. Now, of course, in a world where all the assets are coming from 5 people who all maybe will go to jail, then like maybe that's not exactly the ideal framework to build on. But like, as long as people are committed to the things their decisions they've chose, I think it's fine. I think the hard part, and this is the type of thing that I think we spend a lot of time trying to tease out of people, is whether if like the particular choices they made technology-wise, product-wise, etc., go south, in that like, hey, it turns out to not work for your application, or hey, you can't like get everything to work. Whether you sort of are the person who just kind of quits or whether you're willing to be flexible and changing kind of what you're working on. And I think that type of attitude is much more successful in crypto, where like you could be the most successful app, and then all of a sudden, let's say like the base protocol you're on makes a gas price change, and all of a sudden you're like the least successful one. I mean, it's a hypothetical, but it's very, such things do happen. In Ethereum, there's this thing called gas token a long time ago, which was sort of a rebate on gas. And the moment that left, like a bunch of different applications suddenly like saw a huge drop off. So my point is, there's a sense in which you're always, subject to the market forces. And so are you willing to change for them, or are you going to just be like, okay, well, I guess AI seems easier now, so I'm going to switch to that, because like
that seems to be the trend.
Yeah. And so I think that like from a sociological standpoint, that's something I really try to tease out of people.
So more betting on the founders than the founders' kind of technical ability, regardless of where they initially decide to choose to build upon. Also combined with the fact of obviously what product they're building.
Yeah. So, I mean, I think I would segment it into like things that are extremely technical, like things on the ZK side. Mm-hmm. It's much, much more actually about there's certainly a lot that the person, how they are kind of sort of psychologically in that sense does matter. But I think in the ZK world, you actually do because there's so much technical risk inherent to the product you're building, because you're sort of building something that's like very 0 or 100, right? Like either it's a platform and it works and people can use it and like build a ton of other stuff on top of it, or it's just like too clunky and no one's ever going to use it. There's really not a middle outcome, I think, for a lot of ZK stuff, because it's already a hard technology to explain to people, yeah. Let alone a hard technology for like an average software engineer to be like, hey, I'm going to like write a circuit in Circom, to then like, hey, I'm going to like productionize this and like be able to monitor it and like spin up 500 instances of it. Like you kind of have to de-risk each of those steps in that pipeline, and you have to de-risk that. You have to be very cognizant of exactly your plan to do that. And I think for extremely technical things in MEV and ZK, I think there is a higher weighting on the idea and execution. Whereas I think for things that maybe you could pivot from or could change your product direction on, then it's much more on the psychology of the founder.
That makes sense. Maybe transitioning a little bit, but staying on the topic of like the core infrastructure. You have, obviously with Gauntlet, like evaluated quite a few of these protocols. I've seen you at like the Celestia events and like moderating talks there. And so I feel like you have a very full picture view of the entire ecosystem. I guess my question here being, why do you think there's not like more adoption on chain? When I look at like Dune Analytics, like OpenSea and Uniswap have less than like 5 million active addresses ever, like respectively on each. But obviously both of them do tremendous amounts of volume. What do you think we need to do to kind of get from like the low millions in like active addresses to like hundreds of millions and billions? Is it better applications or is it better infrastructure? I'm curious what you think.
I don't know if it's necessarily better infrastructure. One of the most used applications at some point was actually UST, and I will give the Cosmos SDK a lot of credit for standing up through the blow up. I don't know if any blockchain client has ever had to handle as much traffic live as it did when UST was blowing up. Period. Like I was like looking at some of the bandwidth numbers some of the node operators were claiming, and it was like unreal. It was actually insane.
And the gigabits?
Yeah, it was like some of them were claiming that they were getting like terabits worth of spam added up over like, you know, hundreds to thousands of nodes, something like that. It was like because there was tons of people trying to get their money out all at the same time. And then there were a ton of people who were short UST who were also trying to like knock down the network so that people couldn't get the money out. So it was like a very interesting like game theory type of thing. But UST actually did have quite a bit of usage, and I'm not going to say that was a good thing necessarily, but I'm going to try to point out that I think they did focus on some application use cases and convincing people that, you know, that type of stablecoin is the thing to look for. So I guess I would say, yeah, I think it's application driven, not infrastructure. I actually think like there's a lot of infrastructure that, if anything, like the infrastructure side has been extremely invested in, perhaps overinvested, minus ZK, because like I actually think that that's quite important. And you know, the real question is like, what application could people use? And the unfortunate part of it is, it's not even just that you have to have a good application. You have to have some sort of good UX that these new users are going to be comfortable with. And I just am not so sure how wallets will ever kind of come to parity with like systems that are centralized, at least, you know, in a sort of a sense in which it's like a random person on the street, I could like give them a flyer, a QR code, and say, download this app, and they would be onboarded. You know, like in the same way, like every delivery company, like I can't walk outside on the street without like 5 people giving me a little thing of like, scan this QR code and get $5 free off your next grocery, right?
Yeah.
I don't see how that happens with wallets.
Do you think, I mean, in that sense, I mean, in 2020, like I think like Compound was really kind of one of the biggest pushes for the bull market. And then afterwards we saw like the innovation and cool things happening in DeFi summer and having the benefits of everything being on a single shard and being composable. With the UX problem and layer 2s and different like app chains or like kind of breaking apart or segmenting state, do you think that is going to be more problematic than like large single shard networks that are now coming online like Sui or Solana or even Aptos?
Yeah. I think that, you know, just as we have in normal cloud computing, you do end up having like a separation between the performance dominated nodes and the kind of split up purpose built ones. So I'm not so sure there's like such a clear dichotomy where like one is going to win out. I think it's going to be just that like certain applications do better on one and certain applications do better on the other. But I will say I think the sharded stuff robustness wise is a lot better. So like applications that need to be a lot more robust in the sense of like, you know, the users are unwilling to tolerate like certain types of deviations from the expected protocol will probably go there. And then things where everyone only cares about responsiveness and latency will go in the other direction. And there'll just be some trade-off between them. Now, again, this gets back to the part that I don't understand games. I don't really understand games that really want to be low latency, but also be on a blockchain. Cause like, I think I think a lot of the blockchain native games that have like worked like Dark Forest actually very like asynchronous interactions. And that's why they're kind of like easy to use relative to trying to do something like Star Atlas, which I feel like is just like really hard problem. So other than trading, it is hard to come up with these low latency use cases that, at least like in my mind, like maybe this idea of like a game on its own shard sort of makes sense, but a game on a low latency shared machine just seems super, super hard to ensure the UX for people.
In what aspect? That,
like, if there's traders who are doing MEV to try to like constantly be at the front of the block, then you're going to just like observe lots of jitter as the user in the game because you actually have no guarantees. And like your transactions are just worthless relative to the traders' transactions. So they're always going to be willing to pay more than you, but you have to share the same space. Right. It's as if you went on a subway and there was a notion of like first class in the subway. And you know, like, but like the first class and then the demand for the subway card didn't make sense. But yet, you know, somehow the first class was always full or always empty, and the back was always full and cramped, and it didn't like quite optimize distribution correctly. Because like I do kind of think the problem with games is like the users don't want to pay much per interaction. Like the cost per interaction has to be down, whereas the cost per interaction for traders can be sometimes arbitrarily high. And like having those two economic models shoved into one thing seems sometimes a little hard for me to imagine working.
I do want to talk about MEV, but maybe before that, what are your thoughts on like? It's been interesting following Solana's architecture. I think they've done a bunch of like unique things, but I'm curious to get your thoughts on like fees per contract and trying to isolate those like individual hotspots instead of doing global fee markets. Do you think that will have like a big impact on the network, or other chains will adopt this, or what do you think like the pros or cons of adopting something like this are?
Yeah. So yeah, as disclosure, I wrote a paper on this with some people on these kind of dynamic fee markets and under what circumstances you can actually optimize them in a blockchain. There's sort of two threads of this. One is the Solana version, which kind of has this like hot and cold spot type of fee modulation. The other is sort of the Ethereum version, which is multi-dimensional EIP 1559, which is like storage will have its own base fee and like its own sort of like adjustment, versus compute will have its own adjustment, and maybe different types of opcodes will have their own types of adjustment. In some sense, they're two similar things. It's just the level of aggregation at which they're doing the fee adjustment is different. So, you know, in the Solana case, they're choosing the base unit of like the thing that's having a dynamic fee as being a contract. Whereas, you know, in ETH, it's more close to like the function call and opcodes themselves versus, you know, like a particular contract. I think there's clearly something like this that will work. It's just not clear what aggregation level is the correct one. I think the other interesting thing is like you do open up a lot of DDoS vectors via these dynamic fees, where like you can cause the fees to go up in a particular contract to lower its quality of service so that like only the highest value users can use it. Not saying that's necessarily a bad thing, right? Like
just for continued DDoS.
For Uniswap, that's fine because like, well, the LPs are making more revenue in some sense. So it's like, it's not like so bad in some ways. But for a game, again, it's like, it's not clear that for a game, you really don't want that. You don't want like the person who's like, you know, there's a reason like all of these like game companies have these huge fraud teams to try to like kick out all these bots that are like, you know, causing people to not be able to get items when they are supposed to and stuff. So I think there is sort of this interesting question of like, should it be regulated at the contract level or at the opcode level? And not to sound overly philosophical, but this is sort of a communism versus capitalism debate, in the sense that like, one is like, do we tax you at the level of like raw materials? Do we tax like the wood and the oil and the raw imports, but then after that you do whatever you want? Or do we tax you at the level of like property? Like you own a property that's consuming resources, we're taxing the property a fixed percentage. And there's quite a big difference between them, because let's suppose I'm an oil refinery, then it's possible that being taxed on oil is actually worse for me than being taxed as a property. On the other hand, if I'm a household, being taxed on oil probably doesn't really matter because I buy it indirectly through, and like I don't feel it directly, but the property tax does matter. And so there's sort of a sense in which the choice of how you do this favors certain types of protocols and makes others worse. And so it really does boil down to like, how much do you want the state, the layer one, to own, to control this, versus how much do you want the individual apps to control it. And I think there's definitely there's going to be dynamic fees like this, right? Like I think EIP 1559 proves that dynamic fees are better user UX in a lot of ways. And yeah, it's just going to boil down to what aggregation level makes the most sense. And I think the Solana model makes sense in the following sense. If the MEV from a particular contract can be distributed in some ways partially to the app itself rather than strictly to validators, then there's a sense in which, like, okay, if I'm a hotspot and I'm causing a bunch of congestion, but at least the application gets some of the value from that, not just the validators, then there's a sense in which I'm now incentivized to do some sort of demand smoothing. Versus like otherwise, if I'm an app and I'm a hotspot, I'm just like, whatever. I'll let it stay hot and not try to like ameliorate it in some ways to like get more fees. So there's some trade-off between like how much goes to the validators and how much goes to the app. On the other hand, the EIP 1559 type of thing gives nothing to the app ever, right? So the only redistribution it can do MEV wise is to stakers. And I think you already see that difference philosophically between ETH and Solana, in that, you know, in Solana's MEV auctions on Jito, people are bidding effectively on a per function call basis. So it's like I'm bidding in an auction for like swapping on Uniswap or swapping on Mango or something. Whereas in ETH, you're bidding on the whole block. Theoretically, you're bidding on like sequences of transactions, but you know, in the current MEV boost model, you are bidding on the whole block. And there's, again, this aggregation, disaggregation problem. Like, is it better to have many auctions for like every possible function call, which is hard to bid in, but maybe it's because it's more granular, people are like more close to their true value? Or is it better to throw everyone into one thing and you're bidding on the same thing? And these aggregation versus disaggregation types of problems are fundamentally, in my mind, the difference between like socialist systems and capitalist systems. And we're kind of like, we're sort of like, you know, the different countries are choosing their models.
And the capitalist system is per contract or on the block level?
Yeah, I think it's a good question. I think the per contract thing is a little closer to like pure capitalism, where like the raw inputs are sort of priced differently for each contract.
Yeah. Interesting. I don't know. I find all this fascinating. It's a deep rabbit hole. It goes very deep. Maybe one last question on like just infrastructure, and then I want to talk about like MEV, because I know you're an expert in that field. I'm very curious on like Ethereum long term. Like, what do you think will be like sufficient enough throughput? I know once full sharding is implemented, or not full sharding, but more data availability at the base layer, it will be 1.3 megabytes per second that the L2s will have to consume. What do you think, like 1.3 megabytes at the base layer is going to be enough throughput for like Ethereum's demand, and other chains will kind of consume excess demand, or do you think Ethereum will continue to add more throughput if it's needed?
This is a great question that I don't have a particularly strong answer on, not because I don't have beliefs in what direction it'll go in, but because having seen the politics around this change since 2018 quite dramatically, I don't actually
just on Ethereum's roadmap.
On Ethereum's roadmap with regard to sharding, like I think the idea that like rollups started taking off kind of took off a lot of pressure from the Ethereum team to shard immediately, and then like they haven't even decided on the slashing rules for sharding. Like the light clients don't quite make. There's a lot of stuff that's so open that I hesitate to make any prediction about this from the like sociological standpoint. From the technical standpoint, I think the reason you're doing things like EIP 4844, which is like you can write blobs that live in a different economic zone, but you can't do compute on them, and that's for the layer 2, other than the fraud proofs, is sort of a sign that throughput will go up, but it's going to actually be harder to measure because the blobs should count too, but they might be much larger, but they might not have any compute done on them. So it's sort of, we are moving to a world where data availability has tiers, where there's like highest data availability, like I need to write on the chain, I need the swap on mainnet. There's sort of medium data availability, which is like the blob for an L2. And then there's sort of like the lowest data availability, which in the cloud world would be like the archive tape node type of thing, which is maybe data availability elsewhere that like I only have a proof for. So that's the Celestia or EigenDA model of the world. And so if we look at cloud computing, it's pretty clear they had the same things of like very hot data storage, medium, and then cold, which is like archival. And I think we are kind of converging to that world such that the concept of throughput will somehow depend on how you want to average the 3 different versions. Like, I think at the hottest level, it might not increase that much from the current speed. But if I start including like the blob bandwidth and the DA bandwidth, if there's a lot of usage, that could go up dramatically if you add those in. So that would be my view in that sense, and that it will go up, but not in ways that you might think, not in the ways that like the one number might say. You might need like 3 numbers.
I like breaking each of those out. That makes a lot of sense. Do you think more throughput's always better, or are there downsides in terms of like storage?
I mean, there's downsides in terms of UX for developers, right? It's like now I have to think about where I'm storing something, and I have to think about like how the access works, and like there is a sense in which developer friendliness goes down the more you force people to separate different types of compute and storage, right? Like there's and that in turn leads to user UX being worse because it's like the user is now implicitly managed. And I remember in the early days of like, I don't know, I hate the phrase Web 2, but whatever, Web 2, like 2009 or 2010, there'd be so many apps you'd go on and you'd like log in, and then it would just like take forever. And if you ever like looked at the JavaScript logs or like the iOS logs, you would just see it's like trying to hit Amazon S3 and like waiting on like the storage thing to like give you back an answer. And then of course people started making like caching things and CDN like things. But my point is like, I think we're just kind of doing the same thing here. It's just like slightly different because some things require cryptographic proofs. Some things require cryptographic proofs only on fraud, and some things require very, very infrequent proofs. And though that aspect doesn't exist in the Web 2 world, you just kind of like trusted the person, you trusted AWS will give you the right thing every time. You never really had to verify that they did.
Yeah. Interesting. No, I think about this a lot and I wish as an industry as a whole, we could come up with more like standardized metrics to kind of judge, one, like decentralization, because I think that's always a hot topic, but two, just like different scalability levels. And I always I like throughput just because it's, at least on a high level, I think one of the more basic metrics that at least you're able to do a more apples to apples comparison, but it does get a little bit more nuanced as you, I guess, break apart what data you're submitting and different, what data is included in that throughput.
I mean, the thing is, if you're starting to separate compute throughput versus data throughput, which almost every computer architecture in history, you know, like I worked on a lot of non-von Neumann computers, which are like look very different than like x86 in your box right now that you're using. But like even then, you still there are very few things that force the compute and data throughput to actually be pipelined to be the same. And I think, yeah, even like the current Intel chips are not really truly von Neumann architecture. Like the L1 cache is split into data cache and a compute instruction cache. And so there's a sense in which we all of these optimizations that we've discovered over time have like boiled down to actually separating compute and data and like burstily having throughput for one or the other and then like matching those as best as possible. That's a very coarse view of it, and I'm sure there's a bunch of hardware people who would kill me for saying that. But you know, I think I think they still would probably agree with the direction of that. And I think in some sense that's like the same thing we're converging to in blockchains, except we have this notion of like how much value is there per unit latency. Like the data that needs to be there all the time has to also be high value. And the data that doesn't need to be there but can be cryptographically verified infrequently is the lowest value. And so now we're deciding how much we want to pipeline throughput based on like the value we're assigning to each of those components. And I think, you know, the Solana version of the world is like, let the market contract decide what that value is. And then the Cosmos version of the world is like, I decide my own values, and like if you want to accept them, then you can cross in from IBC.
Yeah.
And then the ETH version is like a little more like the normal computer, maybe a little more authoritarian in some regards in terms of choosing these particular prices. But it's the ETH version actually looks the most like a normal computer in that like the roll-ups are like your GPU or a sound card or something that has its own, or NIC that has its own memory and execution, but it's still getting bussed by the main thing.
I like that analogy.
And so I think Ethereum is definitely like looking like a computer. Solana is looking more like a ASIC, and Cosmos is just like, I don't know. It's very hard. I don't think there's a hardware analogy because like you don't design hardware the way like Cosmos is built.
Yeah, that's funny. I like those analogies though. They paint a pretty clear picture, I think. Super interesting. So maybe on the topic of MEV, and I love maybe just to start with like order books versus AMAs or AMMs. And I think initially just AMMs became the standard because throughput and latency was just very high on these earlier chains, but now people are trying to build order books on chain as well. What is kind of your thoughts around the differences between the two? And do you believe one will kind of be dominant over the other over the long term, or they can both like coexist?
Yeah, I mean, look, I have a invested stake in AMMs in the sense of like, I've written all of the early academic papers on them. And so I have spent a lot of time thinking about them. And when I first came from trading and I saw Uniswap in 2018, I was like, how are people not getting constantly picked off? Like, why would anyone do this? And then, once there was like $15 million, it's like, there's got to be some reason that this works. And then, that's sort of how the math stuff came out. But I think there's a sense in which people have to remember that like not all traders are like purely highly rational profit seeking. And one thing that's worth pointing out about Uniswap LPs is that I think in a lot of these mark out versus like long-term growth threads that we always see on Twitter, is, and markout is like, normally in algorithmic trading, for instance, a markout is the way you measure your performance over like a fixed time horizon. So it's like, hey, here's how much I started with, here's how much I ended, what's the percentage I got to. And in AMMs, most of the math is actually done over no fixed time scale. So you look at like how the portfolio value grows over time, and then you look at a rate of growth, but you don't like fix it to a time window. And those two are statistically extremely different. Of course, Twitter threads have no nuance of that form. So people are just like, look, like this thing is bad. So unfortunately, there's a lot of detail into exactly what assumptions are being made, exactly what you're taking an average over that. And those two things aren't the same. So like, but whatever, ignoring the fights.
That's why podcasts are important.
Ignoring the fights. One really important thing for growth in DeFi summer was that DAOs, who are passive capital and large owners of tokens, could provide liquidity for people to buy their governance token, to vote in their DAO. And those DAOs are not economically rational in the sense that they're not trying to monetize their token and make money off of it by being an LP. They actually want to be a passive investor. They just want exposure to like the beta of this thing. And they don't care about optimizing exactly the fees they earn. In the same way that people who buy ETFs behave, right? They're like, okay, I want exposure to the tech sector, but do I care that I'm getting the exact optimal portfolio? Not exactly. I just kind of am like, I want roughly that. And these passive capital allocators who are not necessarily purely profit maximizing oftentimes serve as the liquidity of last resort when markets are collapsing, right? Like these DAOs are not like, when the market's crashing, a DAO is not like trying to remove its liquidity from the Uniswap pool. And so in general, I think like there's a place for liquidity that's sourced from people like that. And especially when you're bootstrapping a token where, the people who have the token are rich in that token. They actually are fine losing money in that token's terms because they're actually just trying to get anyone to use it or have access to it, which is very different than like, what's my exact markout? I think that part is always missed, is that the bootstrapping, this is like a bootstrapping cost.
Yeah.
And it's actually a kind of cheap customer acquisition cost in some sense. It's like, it's basis points versus like, I don't know how much the delivery companies raise to give away, but it's like clearly billions of dollars versus like, I'm giving you basis points of loss in my token. Like that's a very cheap customer acquisition in a lot of ways. So from that standpoint, AMMs are just easier to bootstrap with than an order book because like a DAO cannot be an active participant. It can barely vote on one decision. How is it going to like constantly be, And so I think there's a world where passive capital is important. Now, does that mean that, hey, we shouldn't like improve the designs? Absolutely not. I mean, there's a reason I've written like 20 papers on this stuff. It's like there is a way to improve things. There's a sense in which there's this trade-off between passive and active participants. But I think, the analysis of like the pure return piece, I think is somewhat misleading because it misses this fact that like a lot of the biggest LPs are actually these passive providers who can't adjust their liquidity.
It makes a lot of sense. And it's an interesting point of view. So essentially long DAOs and kind of passive LPing into AMMs. There's definitely
and if you look at finance over the last 10 years, other than the 2019 to 2022 like retail finance boom, people were just moving all their money into ETFs and not like buying individual stocks, right? There was like a huge, so like there's always going to be this pendulum swing between like way more passive, way more active. But the beauty in crypto, in DeFi and crypto is the DAOs themselves have a lot of incentive to be these passive providers in a way that's very different than the normal market where like, if I'm like, Square, I'm not like going to take my Square stock and go market make it myself. I'm going to go sell it to a broker. And obviously that broker is charging me a fee. So I'm losing money technically, right? Like It's like almost much more efficient to just have an AMM, have some bounded notion of loss, and that's good enough.
Yeah, that makes sense. Fascinating. I guess like on the topic of order books on your on chain, what are your thoughts surrounding those? I mean, obviously you've spent a good amount of time on the AMM side. On the order books, do you think, I mean, just with the distributed nature, they're always going to be slightly less efficient than a kind of centralized order book, but what are your thoughts there?
Yeah, I mean, I think the thing about order books is like they work best when you have products where people need a lot of fidelity over the sizing versus price, right? Like an AMM in some sense is like you have no fidelity over sizing versus price. That's just fixed, like effectively the kind of rough ratio you're getting. And an order book is like something where you really want to have more granular control over that. And there's a computational complexity difference between them. Right. An order book requires many more updates to stay synchronized. AMM requires one, but obviously splits the revenue differently. And so I think the hard part in blockchains is that the number of updates costs you more. And so there is a tendency to optimize, like to reduce gas costs over time. And then if that's true, then you'll tend to use the things that like have fewer updates, even if they have less fidelity. And that's sort of like an interesting trade-off that's like the opposite of the trade-offs that you make in AI. In AI, you're not ever trying to reduce these kind of computational complexity. You're trying to just throw more hardware, throw a larger model always, and especially in 2023. And that's sort of a very different, like the approach of an order book is a little more like the approach of an AI, where you're like, you want to allow for a lot of complexity and expression. And I think for things like perps, that does matter. For things like spot trading, it's not clear that it always matters. Like it definitely does sometimes. And for things like NFT order book, like constructs, like SudoSwap, I'm not 100% sure you totally need to do that, but I think there is definitely a need for it. I don't think it'll ever be as good as the centralized version, but I also don't think that, I think people now understand the centralized version can rob you. So it's like, you know, that default risk wasn't added into your latency calculation.
Yeah. Interesting. No, it's all definitely thought provoking. Yeah, it is interesting just thinking about the different trade-offs. On maybe that front, I mean, obviously you've been through a lot of bull markets and bear markets now. Was there anything, I mean, outside of, I mean, I think FTX obviously caught a lot of people off guard, but is there anything like this bull market that uniquely surprised you, or do you feel like it was all kind of plays out similar to past cycles? I'm curious to see what your thoughts from this last like giant run up.
I think like every crypto market has the bull market has the following, where there's like some real innovation that causes things to go up, and then there's kind of this like plateau, and then it becomes like scammer central, and then it crashes. Yeah. And you know, in 2017, I feel like it was like definitely all the proof of stake chains. Like if we look at the top performing ICOs that like still exist and like are used, it's like Polkadot, Cosmos, Tezos, ETHLend, which is Aave. Those are, you can't say that those scammed you, right? Like they did raise the money and they did build a working blockchain, and like there are, you know, some users. I mean, in the case of Aave, they're real users. In the case of Cosmos and Polkadot, there's some users. And Tezos, I guess Tezos NFTs actually do have a lot of users. So, but my point is they are real like investments, right? And those were all, for the most part, earlier in the cycle. But I think it was like once people saw, oh, like those investments went up, then they started, then like it was a lot easier to have the fraudulent things. I think the difference this time is that the fraudulence was like systematic in Solana, Luna, and AVAX in some way, which is like unfortunate for those ecosystems, and that it will be hard to kind of like remove that association. That being said, I think the other difference that was crazy was definitely NFTs, because like NFTs to some extent, people were always like, there's always like this meme of people like, oh, like self-custody is too hard, no one's going to do self-custody, which I think for like high enough value, that's probably true. But for low value transactions, I don't know. I mean, I don't totally think that's really true. And I think NFTs were interesting because they were sort of the biggest event that caused people to download their own wallets. Like I remember around the time that like SafeMoon came out, there were just like people giving out TikTok videos of like how to install MetaMask and then change your RPC to like BNB chain.
Crazy.
And I was like, there really are these TikToks for like, you know, people are like, you know, no one ever did that before for like installing wallets. And so clearly there was something that struck a nerve. And like, I agree with you that like that type of stuff will probably get more users. I just don't know. Yeah. What that will, that sort of would be, the NFT boom would actually be my positive, in spite of me not liking them or understanding them. I think there was this huge positive of people got used to using self-custody wallets. That was quite different. That was like not really true even during the 2017 boom. I mean, there were certainly some ICOs you had to participate on chain in, like say the Status ICO, which was famously like the first form of MEV that ever existed, or that was publicly, you know, became an issue, where this miner front run everyone, inserted their own transactions. And then people started shaming them, and then everyone stopped doing MEV for like a year. But I think like people weren't doing that many on-chain transactions. The wallet sucked. You know, you basically had to run a node. You couldn't like, the light clients were not that great.
DAI came out in like December of 2017, so almost at the Pico top. But other than that, was Tether existed? There wasn't really many.
Yeah, Tether existed. So Tether was on a side chain on Bitcoin where it posted proofs every once in a while.
I remember it was sketchy.
Yeah, and then they eventually moved to ETH. And one of the funniest things about that era was like all the Bitcoin maxis were like shitting on ETH and like being pro Tether. And then like at the same time, like, and including the people who make Tether. And then at the same time, they were moving all the Tether supply to like ETH and Tron. So it's kind of ironic.
Yeah. Crazy times. Yeah, definitely wild past couple of years. I guess wrapping up the podcast, is there anything in like 2023 that you're uniquely excited, either on like the infrastructure or application front, that you're either looking to invest in or just excited to watch the progress in?
Yeah, I mean, I think the things that I'm most excited about, and obviously the disclosures investor in all of these, is Axiom, which is a way of taking historical data on the blockchain and basically getting validators to generate give you the answer. Like they can give you a SQL query over the blockchain, give you the answer, and then give you a ZKP that they computed it correctly. So it allows sort of smart contracts to introspect their own state. So right now, if you think about protocols, they sort of have to have this time invariant property. Like the contract isn't really allowed to look at its historical state very much, like unless it stores all its historical state. And obviously that's expensive. So contracts really tend to like look only at like the right now and maybe like a little bit in the past state. But usually you don't really need all the state from the past. You want some summary queries, but those queries will change depending on the user's demands. And, you know, right now, what do you do for that? Well, you know, you go to people like Gauntlet for governance, where we do these queries, optimize them, and submit a proposal. Or you go to Dune and you do a query post hoc, right? Like you go to Nansen. Like those are all different ways of doing that. But the contract itself can't do that anywhere. in any chain. And one interesting thing is validators could offer that as a service. Obviously, I think like the Graph and stuff have tried to do it, but they've never been able to do it because it's actually extremely expensive to do this. However, there are certain things you can actually do ZKPs of that efficiently that would allow a contract to introspect itself. And that sort of changes the design space of some of these mechanisms, because you can now use the history of how users use your protocol to change the parameters of the protocol in some sense. The second thing is, I guess who you've had on this podcast, Eigenlayer. Personally, I'm not that interested in the data availability use case for Eigenlayer. Not that it's not a valid one. I think it's just like, I think there's like a lot more interesting things you can do with it that no one else has thought about. Like the data availability thing is like, there's a lot of people trying to do it.
Yeah.
Whatever. But there's a lot of more interesting things you can get validators to offer as services when they're restaking. For instance, generating zero knowledge proofs for Axiom, or providing Oracle updates, or guarantees on MEV redistribution. So one of the hardest part about, we talked a little bit earlier about like redistributing MEV is, well, why are the validators incentivized to do that? In some sense, they could cheat off chain. They could just be like, oh, like send me your order flow off chain and I will, execute it, and we'll skip the Flashbots auction, right? We'll do an off chain agreement that's separate. And we'll avoid redistributing it. So then like you and I split the revenue from the MEV, and then we don't have to share it with the other stakers, right? Now, of course, that is hard UX wise, order flow wise. There's all this other stuff that makes it more difficult to do. But in theory, it's still possible. One way of trying to get around that for redistribution is to use something like Eigenlayer, force people to restake, and that way they're committing to a staking pool. Arguably something like Jito on Solana does something similar, but the thing is they can't change the consensus rules to enforce the slashing. And Eigenlayer sort of gets around that in some ways. And I think like we'll see a lot of things that are using restaking to force covenants so that if validators are providing these services that they can't cheat, because they actually have the biggest incentive to cheat in a lot of these circumstances. And so I'm just saying, like, to me, those are much more interesting applications, and they actually like, there's just data availability, I feel like, is great, but I do think it's going to be a little bit like storage in that, not Cryptos blockchain storage, but more like Dropbox or Box, in that it's certainly a necessary business. People are going to really want it, but it will kind of eventually have margins that erode. Financially, it's actually hard for me to imagine it being like extremely sustainable revenue for a network, which is also why people are fine outsourcing it. But I do think that these other kind of things that you can do with restaking are very sustainable businesses. Like you basically can guarantee properties of these MEV auctions that you couldn't otherwise, because they're technically outside of consensus. And once you have that, then you can, I just, to me, that seems like a source of revenue that like people have not really kind of tapped into.
No, I like your framing and your idea. I haven't thought of that too much, and so it is interesting. I think when people think of Eigenlayer, they think just about the Eigen data availability, as you said, and so figuring out the restaking and how to use it in different unique ways, that would be exciting as well. Got me thinking. Interesting. Well, cool. I really appreciate your time. I appreciate the chat. I love your unique insights and just how you think about some of these things differently than other people's. I think obviously that's made you and the Gauntlet team extremely successful and great early investor as well. So definitely appreciate you sharing all your insights, and appreciate you coming on the podcast and sharing all your wisdom.
Thanks for having me.
Thank you.